A modest slowdown for the U.S. economy next year, according to LPL Research, but there's still good news ahead. Hello, and thanks for joining us for this week's Fastest 4 Minutes in Finance. I'm Scott Inman. The LPL Research team recently released its Outlook 2026 publication, and it's a counterbalance to the gloom and doom headlines you're probably reading a lot of right now. So here are some of those headlines. The research team thinks the U.S. economy will experience a modest slowdown in early 2026, but will rebound later in the year. And the reason? Underlying resilience from AI-driven investment and fiscal spending that should offset weaker household activity. The LPL Outlook also predicts there will be no recession next year. Now, that should provide more steam for the bull market, just not the kind of steam that's powered the train for the past 3 years. The S&P 500 index was up 24% in 2023, 23% in 2024, and 15% this year, with 2 weeks left in the year. Historically, the index has been up 15% or more for 3 consecutive years, only 8 times in the past 100 years. In 4 of those times, the index kept running higher in the 4th year, but in the other 4 it fizzled out and returns were negative. So LPL Research contends that the enthusiasm over AI is a long way from fizzling out, and that should fuel the market higher in 2026, along with easing monetary policy in the form of continued interest rate cuts. However, valuations are running high, and next year is a midterm election year, and that tends to increase volatility. LPL has a year-end target range for the S&P in 2026 of 7,300 to 7,400. And that would be about an 8% to 9% gain from where the index sits now. As far as other asset classes go, LPL believes bonds continue to offer compelling income opportunities, with starting yields still elevated relative to historical norms. They write that 10-year Treasury yields are anticipated to remain between 3.75% and 4.25% in 2026. As the Fed continues to lower short-term rates, returns on cash may continue to decline, and it could make high-quality bonds with intermediate-term maturities more attractive for long-term investors. And there is also reason for some investors to look at alternative investments, like real estate and private equity as an example. We'll get into that in a future webinar. That's coming in January. Be sure to be on the lookout for it.
Want to become smarter financially in 4 minutes or less? Sign up at fastest4.com to get insights and updates like this delivered to your inbox weekly.